Hi, my name is James, a private client advisor at Harrison Brook, and in today's video we're going to run through the difference between passive and active investing, what the difference between the two strategies are, and what's likely to suit you and your portfolio. So a passive fund, or a tracker fund, as the name would suggest, is one in which it buys a proportion of an indice, whether for example it's the FTSE 100, the S&P 500, or potentially a European index, and aims to track that index and obviously monitor and mimic the performance of that index itself, which obviously differs from active investing. Generally these funds are pretty low cost depending on which index you're buying into, and also they can buy different proportions into different indexes across the world. So an active fund or a mutual fund varies quite a bit from a passive, in the sense that rather than being an algorithm which tracks an index, you've got a team of analysts as well as fund managers and etc. actually monitoring, buying and selling different instruments on a daily basis, whether it's equities, fixed interest securities, or potentially more niche areas. Typically these are more expensive because there's a lot more work involved in the actual management of the funds, but the idea is that obviously the fund manager is trying to outperform the benchmark, and depending on the style of the fund manager, their track record and everything else, the aim is to be consistent in this respect. This is a question we get a lot from clients, and in truth the answer depends entirely on your preferences and what's important to you. So obviously passive funds, you may feel like you're getting more value for money. They're generally very cheap, ranging from as low as 0.06 from your likes of Vanguard and BlackRock, probably up to 0.65%, depending on what it is that you are tracking. They're very low cost, and then for that reason a lot of people do prefer them. However, more sophisticated investors will tend to lean towards mutual funds and actively managed funds, perhaps thinking that they have a bit more information than others, and the market isn't perfect in the sense of the distribution of information amongst fund managers versus a computer tracking an actual index. So within the model portfolios that we run at Harrison Brook, we like to have a blend between the two. The reason being is that actively managed funds and passively managed funds can complement each other in a portfolio. Passive funds are obviously going to fall and rise with the market, whereas actively managed funds have slightly different strategies. They'll have different weightings with respect to the asset classes in terms of equities and fixed interest securities, and because of that the performance can vary, and especially in times like coronavirus and everything else where market drops are they're inevitable. Having actively managed funds in there to complement your portfolio might help you diversify in terms of your investment strategy. Thanks for watching. I hope you found this video useful in explaining a bit more about how the different types of investments work and their investment strategies. And if you do have any questions, please do feel free to get in touch. Thank you.